All right, we're at the hour. Check, radio check. This is, I'm gonna try and go a little slow. This may take the full 30 minutes. So, forgive me. I'm not gonna go into my usual, what this is about, who we are, all that stuff. I'm really gonna dive into it because this is a question that a lot of, not only myself, but a lot of our advisors across the country have been getting. So we wanted to make sure that we touched on it, and we're not going to be able to cover the complete topic this week. So my thinking is I'll do a part of it, and you'll see when I start to talk about velocity and how the banks utilize that I'm going to save that topic for next week in a story that I typically teach and train on, called A Can of Peas. So if you've not seen or heard that, this will sort of be a high level conversation today, helping people to understand how the banking systems, the actuarial insurance systems, and the custodian systems work to protect money, and then we'll go from there. So without further ado, I want to thank all of you for taking time out of your busy schedules. And I also want to say, tomorrow's Good Friday, so want to make sure I wish each of you that do practice that faith a happy Good Friday. All right, so without further ado, is our money safe in 2023? It's a great question. And we need to look at, how things work. So let's look at some basics. So depositing money into a bank versus an insurance company versus insurance custodians. When you make a deposit at a bank, this is something that is referred to as a fractional reserve system. The deposit is a liability on the bank's balance sheet. The banks then loan that money back out / velocity of money. And again, I'll talk about that next week more in depth. And the goal is to earn a net interest margin. So it's not really complex when you think about it. It's like, hey, if they can give you, and let's just say in today's environment, they can give you somewhere around 4% on money, and then lend your money out in credit cards or mortgages at something higher than that, that differential, that delta, is what we call net interest margin. And then accounts at banks are FDIC insurance, and that's federal regulations. Now, there's been some, a lot of you have heard of Silicon Valley Bank or First Reserve, and actually Credit Suisse. There are some banks that have got challenged. We'll get into that on the next slide. But the FDIC insurance, and one of the things we always look at is if somebody has too much money in one account, and that's per account, right? So, if you have a bank, you have an account with $250,000 in your name, $250,000 in your spouse's name, and then you have $250,000 in a joint account, each of those would be insured to $250,000. But if you have $750,000 in one account and that bank defaults, bar the government doing what they did for SVB, you will lose money, right? So that's the risk of having account values over that. Next is insurance companies. They use something called an actuarial reserve system. They deposits plus the actuarial payments are a liability on the sheet. So it's not just what they owe, but it's what the promises are as well. The new premiums are needed and wanted to meet these future obligations. There is in each state something called the State Guaranteed Association for Insurance. And, advisors are not allowed to use the state guarantee as a solicitation tool. But because this is purely an educational presentation, I'm allowed to explain at least how it works, right? Now, insurance companies also use something, a net interest margin. And when they collect money from a, contract holder, policy holder, somebody putting money into a life insurance contract, those funds typically go into a general portfolio, and future premiums ultimately after expenses and things like that go into the general. After the expenses are paid, everything goes into a general portfolio as well. Now, quite often, though, you will see sometimes with life and annuity companies that they start to separate old book of business, right, that general account versus new money. And that's why sometimes you'll hear me refer to something called buying business. So sometimes insurance companies will offer great deals for a period of time, but maybe it's not extended to existing policyholders. One of the ways that insurance companies help to prevent flight or an exodus of money is that when you enter into an arrangement with an insurance company, they have surrender charges. And usually those are decreasing over a period of time, depending on the type of contract, the policy, and the terms of the contract, which are each filed with each separate state. And then something MVA stands for market value adjustment, also helps with flights. Actually, it worked against insurance companies when rates were dropping, right? Because quite often people could get out of contracts even though there might have been a surrender charge. And typically MVAs only apply if somebody is experiencing a surrender charge, but they were actually more profitable, or the contracts were more valuable than in a rising interest rate environment. In a rising interest rate environment, even though there are surrender charges, they can apply a formula called a market value adjustment that can actually be costly, more costly than the actual surrender charges if surrendered too early, just depending on the interest rate environment. It's too technical for today's conversation. Just understand that insurance companies use actuarial reserve and they prevent flight by having surrender charges. That's pretty much the takeaway here. And then lastly is investment accounts, your Fidelities, your Charles Schwabs, your TD Ameritrade. When you set up an account at any of these custodians, they are separate accounts per Social Security number. So if you have an IRA, that would be one account. If you set up a brokerage account where you're taxed annually, that's a separate account. But it's not a reserve system. So they don't have to take and put any of that money. They're not trying to create leverage or spreads unless you have a margin account at a broker dealer. That's a little bit more detailed than I wanted to get in today, but it's not part of the custodian's balance sheet. And a lot of people, the thing is that I'll get into a little bit, but it's called where I mentioned FDIC on the banks. I mentioned insurance company state guarantee. Under investment accounts, that's SICP or SIPC. And what that is that's insurance in case the custodian were to go defunct, but it doesn't prevent against losses in the account. So that's market risk. So it's just a little tidbit in the side. So now the current banking crisis issues, in my opinion, the current issues are non-systemic and like they were in 2008 or 2010. The problem is right now is like SVB, Silicon Valley Bank. They had made commitments of their funds to longer term bills and bonds. And now when you have an inverted yield curve, that means short-term paper, 2-year mortgage rates, 3-year, 15-year, 10-year are higher than their longer term. So they made some questionable lending practices because remember, they're in a position where they only have to keep 10% on reserve. They turn around, lend a lot of their money out in an attempt to make money and to be profitable. And that turned out to bite them. Now, I'm not going to get into what I think governments can and can't do, but that's why they had a run on their accounts and also first reserve. That's something called duration risk on a current bond portfolio. So think about a teeter-totter, right? That remember, bonds don't like rising interest rates. And if they had bought into longer term bonds and their portfolios dropped, and in an environment today where people want to be liquid, they were probably, people had a lot of money over the 250,000 and then turned around and started to try and pull that money out. And that's why the run into the tune of billions put pressure on, and they had to ask the government for help. Now, the government in this case stepped in and said, hey, we're going to take care of everybody. That's not the government's job. That's what the insurance is for. And just because it happened once does not mean that's going to happen again. Again, I can't get into the speculation of the future, but be careful when there's runs on banks, because at some point in time, I've seen it happen before in 2008, where I saw some people that had funds in excess of the 250, and I had them go back to the bank and reallocate those accounts. There are things you can do. You can put it between different banks. That's a strategy that has worked well and can help reduce that risk. But to counter this deposit flights, the Fed acted. So the problem was the 2-year treasuries dropped 1% in 5 days. It was just like boom. And because they're semi-illiquid right now, people panicked, right? They're like, we want to get our money back, and they were tied up and couldn't do that. So that's why the run on the funds at SVP. But the interest rate declines increase the values of treasuries, helping the bank's balance sheet. So that in longer term, it starts to put them in better position. But in that short need, people come and start to panic and go, I want my money right now. I just was on the phone with one of my clients who's a business owner, and she has $1 million that she keeps cash, right? And when she told me it was with one bank, I think a lot of banks are starting to come up with strategies to be able to divide it internally, right? So we can do that as well. It's more of a one-off. We don't solicit it, but just keep in mind, 250 is that threshold to sort of protect your assets from the sky is falling. But how do they work? Both banks and life insurance operate on a reserve system, the fractional versus actuarial. And banks operate on a 4 to 10% reserve requirement and are backed by the FDIC. Now, this is the link. Obviously, you can't click on it on a Zoom meeting. So what I did is I took us to the link, and I didn't want to be, sitting here navigating live. So I took a screenshot. And what this is the Federal Deposit Insurance Company failed bank list. And if you go back to 2000, right, this is October 1st of 2000 to now. This is what most people don't realize. 565 banks have failed, right? This is why people, sometimes they have way too much confidence in a local community bank. And a lot of times these smaller banks, that's why they will be held to this higher reserve requirement. So that's the smaller banks that have to keep 10 cents on the dollar versus a larger bank, regional or national bank, that only has to maybe keep 4 cents on the dollar. So when you look at this and we say, to understand the money creating process, one must first recognize that our depository institutions, commercial banks and thrifts, operate under a fractional reserve. This means that each institution is required by federal law to hold reserves equal to a certain fraction of a specified type of deposit. These required reserves can be held either as bulk cash or as deposits at the Federal Reserve Bank. If a bank receives a deposit, the amount of the deposit in excess of the required reserves constitutes excess reserves for the bank and is available for loans. Because the bulks of a bank's loans are made by simply crediting the customer's borrower's deposit account, the loan in fact becomes new deposit money. And this is an interesting effect. So when customers borrow or write checks on these accounts and the payees deposit the checks with other banks, the process of setting aside requires reserves, and lending excess reserves is replicated again and again. And this is something that I termed and we call amongst ourselves velocity of money. This is the topic I'm going to talk at a deeper level next week, and I'll keep it very high level so that we understand it. It's not magic, but a lot of people think that they only make money, banks only make money just because they took that spread, that net interest spread. That's not the only way that banks make money. It's this velocity of money that really is the cash cow for them. So this process of money creation continues until deposits amount to a multiple of the reserves supplied to the banking system by the Federal Reserve, where the multiple is determined by the required reserve ratio. The illustration on the next slide shows how an initial deposit of $1,000, Social Security check, at a commercial bank can generate an additional $9,000 of deposits into the banking system under the assumption of a reserve ratio of 10%. Wow, that's a mouthful. And that's why I read it, is because I wanted to go through this slowly so that when we look at this picture, this is an old explanation that the Federal Reserve Bank of Richmond put out back in 1993. And then what they did is that initial deposit up in the upper left-hand corner is $1,000. Well, 10% in the required reserve is $100. So that means excess 900 they can lend out. So now they turn around and lend that 900, the person turns around and puts it into their account. That now means they can keep 90 and lend out 810. And as you go through this systematically, they can do this up to 24 times. And that's where that number, that total at the bottom, $1,000 can create $10,000 total deposits, requiring the bank to keep that $1,000 as reserves, but they got that excess reserves out there in the form of loans, and that's what's generating them a lot of revenue. So banking reserves for every $1,000 deposit, $100 stays in the vaults, 10 cents on this assumption. $900 in excess reserves, loans and investments. The cycle takes 24 cycles, or takes 24 cycles to reach maximum efficiency. And then a $1,000 initial deposit, 10,000 total deposits. That's a recap of what we just went over. Bank-owned life insurance, though, this is one of the, if you look at the financials of a bank, it's one of the fastest growing assets for bank on their tier one money. So if you have not read the book, Pirates of Manhattan, I think it's a fascinating book, and it talks about this and how banks, right? If banks are looking for safe places to put their money, why are they putting their money in cash value life insurance and annuities, but specifically BOLA? It's called bank-owned, or BOLI, bank-owned life insurance, right? And we'll talk about that in the future, but you know, life insurance and the actuarial components associated with insurance companies are considered some of the safest money available. All right, so now we're going to talk about actuarial reserve. Life insurance carriers are backed by the state guaranteed associations, and they're governed by each individual state. If a company comes into New Jersey or New York or Pennsylvania, right, these are some of the toughest states in the country. Right? You have to get products approved, and then they have to be vetted, and then before anybody can put any money. And I'm talking just, you know, life and annuity, but most insurance companies, that's why we have a Department of Insurance in each state. I had a call with an advisor today where an insurance company is giving a policyholder a little bit of a hard time. And one of my last arrows in my quiver, should an insurance company start to balk at one of their legal obligations, I'll tell them to contact the Department of Insurance in that state, or I had the advisor contact the Department of Insurance in an effort to put pressure on that insurance company, because insurance companies want to stay in the good graces of a state regulatory authority so that they don't lose their ability to offer their products in that state. So they don't play around here. But what I also wanted to do is I wanted you to understand, because like I said, the State Guaranteed Association, advisors can't use that as a solicitation tool when they're offering products, right? You have to go on the financials of the company. You have to go on the full faith and credit of the institution, their past track records. But purely from an educational standpoint, you can go and look at, and so what I did is I went to Investopedia. So I gave the Reader's Digest version. Are you protected if your insurance company goes belly up? So, problem with the bad bank, the FDIC has your back. Had a brokerage account that went underwater, that's the SIPC. You are at least partially covered. Your life insurance company goes bankrupt. Don't worry either. There are mechanisms in place to keep you covered. So this is one of the questions when I'm often offering clients a tool, right? It may be an insurance product, but understanding people will come back because they're not familiar of the safety of the company that we're looking to put the money with. Now, the State Guarantee Fund, what is the State Guarantee Fund? A State Guarantee Fund is administered by a U.S. state to protect policyholders in the event that an insurance company defaults on benefit payments or becomes insolvent. The fund only protects the beneficiaries of insurance companies that are licensed to sell insurance products in that state. So again, this is something that is a protection mechanism. In my career, I have seen a couple, not many, insurance companies, life insurance specifically. I have seen one or two health insurance companies go into receivership, and the state has stepped in. Now, one of the things that I've learned in my career, and I just saw the banking industry do that. JP Morgan actually did a great job of leading the charge to collect or ask all the fellow big banks to help these smaller banks that got into trouble with that flight on cash in the banking. Well, the insurance company has done a really good job of sort of policing itself as well. And typically in the past for insurance companies, they don't want to get a black eye, right? That some insurance company went belly up and didn't pay their policyholders and give, the industry a bad name. And there have been cases where they step in and they've made all the contract holders solvent, and they've also helped them and taken over any contracts that were in place and honored those. So, it's really, important to understand that, because you want to have faith that where your money is going, should life happen, that the financial, integrity of these companies is there. And I think insurance are the oldest and largest financial institutions in the world. So when you think about safe money, this is why we look in that direction. Now, an actuarial reserve is a liability equal to the net present value. This is going to be a mouthful, and I don't expect you to get it. It takes a little while to get your head around it, but the net present value of future expected cash flows. So this is, an actuarial term, and basically what the insurance companies are being asked to do is not only when you send in your premium, so if that premium was on a death benefit, right? So and the insurance company ran into trouble, in order to be able to be considered actuarially sound, right, to meet the state's guidelines, that not only do they have enough, so let's say you put in 10,000. You put in 10,000, not only is that 10,000 there, but typically anywhere from 2 to 10, I've seen 12%, 15% of additional reserves. And that's to help pay for the promises of the contract, whether it be a income for life or a death benefit. So it's the net present value of the future expected cash flows. These are the future premiums coming in of a contingent event, such as a death. In the insurance context, an actuarial reserve is the present value of the future cash flows of an insurance policy, and the total liability of the insurer is the sum of the actuarial reserves for an individual policy. Now, I don't expect you to get it, but I just understand, think about it mathematically. We looked at the banking is only required to keep 10 cents on a dollar, whereas for a smaller bank, but an insurance company of an A- or better rating might be required to keep $1.12 or have $1.12. Maybe the only requirement's $1.02, but a lot of these companies pad their books in case an event that was unexpected happens. And that's why they are experts at mitigating risk. So regulated insurers are required to keep offsetting assets to pay off this future liabilities. So quite often that is in the form of bonds and bond portfolios. And that's why quite often when we're looking at what is the general account of an insurance company, it's typically held in bonds and things where that's bond duration and bond durability and going out, treasury bills, treasury bonds. These are just some of these safest vehicles for a long-term perspective. And then, i.e., the actuarial reserve requirements is based on future obligations. This present value of the future liability requirement is much higher than standard. I'm pretty much repeating what I said. I was just trying to make sure that that it was clicking for everybody. So it's much higher standard. That's the $2, $10, $12 example versus 4 cents or 10 cents on the dollar that the FDIC requires. We see fewer insurance company insolvencies compared to the banks because of it. So that brings up the National Organization of Life and Health Insurance Guaranteed Associations. And if you go to this website, NOLHGA.com, and you go over there to the policy holder info, and you go down to where it says impairments and insolvencies, it will bring up this page. And this page is since 2000, just like, so I was matching apples to apples. There's only about 30 life insurance companies in the same time frame that have become insolvent. You compare that, to the banks, and that's why, again, this is not saying that banks aren't safe, but quite often people have a false sense of. If you went through the savings and loans crisis, back in the 1990s, you're familiar. I mean, they get into some shady practices because typically it's a board, right? They're just not as highly monitored. Although SVB did have the regulators came in and they questioned some of their lending practices and asked them to tighten it, and they ignored it and didn't follow up. And then we see what happens. So this is why it's a timely topic as well. So when you're looking or having or concerns about, hey, putting my money, someplace, where do we put it? And this is why when we're making recommendations to clients, not all insurance companies are equal. There's a rating company, a third-party independent rating company called AM Best. And it's a credit rating agency focused exclusively on the worldwide insurance industry. AM Best assigns credit ratings that assess an insurance company's creditworthiness, which refers to the likelihood the company will default on its obligation. We at Professional Planning Services typically will only use A- or better, right? And a lot of advisors don't even know when they're offering some of these lesser companies, their E&O doesn't even cover it. So we always teach and train our advisors to make sure that they're acting in the best interest of the client, that best interest of the client standard. And myself, I'm a fiduciary. That's even a higher bar. So just making sure that, that where we're putting our money, the promises, I was at an insurance company. I remember, I'll never forget when he was the national, I guess Tom was the vice president of sales, but he goes, a promise is a promise is a promise. And, that means something to me because I'm in a position where I meet with clients face to face, belly to belly, knee to knee, and they trust me. And if we're going to make recommendations, I have to have confidence that I've done my due diligence, that what they said was going to happen, right? So quite often, that's why, I'm going to get into some other things next week and in the future, but we take a lot of pride in making sure that our clients are protected and not a quick commission is generated and all of a sudden somebody's in a C+ company and that company went belly up. But keep in mind, if that did happen, the insurance company, the insurance industry has done a good job of coming in and policing itself and taking care of those policyholders. So actuarial reserves, I'm not even going to say all the letters, but it's the National Organization of Life and Health Guaranteed Association, has had 100+ insolvencies since 1983. I mean, that just speaks for itself. If we were to take the same time span on banks, it's much higher. So compare that to the number of banks, right? And that was just since 2000 is 565. For my money, I just feel safe. And a lot of my money is in permanent life insurance, right? It's, I practice what I preach. I'm very comfortable with how the companies operate their financials. And that's why when I'm recommending suggestions to clients on strategies, to avoid market risk, to avoid or reduce tax risk, right? It's also the ability to go to bed at night knowing that I've done and served my clients in the best way possible by not exposing them to default risk. But this is just my opinion. You need to make up your own mind. Okay. So upcoming events, keep this in mind. We got Medicare coming up in 3 weeks. If you know anybody that is approaching retirement, 63, 64, 65, or already in retirement and already in some type of Medicare supplement plan, Medicare Advantage plan, and is looking to get educated or maybe change your plan, this is very early in the year because you're going to get inundated by open enrollment by the end of the year. That being said, that will be at Mercer County College. The registration link is on our website, professionalplanningservices.com, and it'll be on upcoming events. The long-term care workshop that we have coming up, I'm really excited about this because, the more and more I'm starting to set this up. I just got off the phone with Rutgers today, where before Rutgers had told us that they were not going to allow us. They are now, looks like they're going to let us open up. So although I only have listed here May 31st and June 3rd, 2 weeks later, we're probably going to be doing a similar class at Rutgers. That's the details still getting worked out. And then I'm going to be working with New Jersey 101.5. I'm meeting with them on Monday and just setting up the announcements to let everybody know in New Jersey to get to these events. So if you want to get there, make sure that you're there and register early so you can reserve your seat. There's no cost to attend. We love education. That's what these venues are. They're education only. Make up your own minds. You can figure out what you want to do. I'm happy to be out there in the public and sharing and educated. So I'm running hard right now. I'm excited. I got a lot of things that in order to prepare for this, because we like to do things proper, and there's a lot of planning. So hopefully we can make that a memorable event. So there's some cute little bunnies. I love animals. It is Easter weekend. So regardless of your faith, from our family to yours, happy Easter, happy Good Friday. I hope all of you are safe and sound. If you need me, please reach out. And here's our compliance ending.